It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to the Jill on Money Show. This is the program that takes the mystery out of your financial life. I am Jill Schlesinger, CBS News business analyst and your host today. And we are here trying to help you make better financial decisions. We do that by asking you to do a little work. Just go to our website, jillonmoney.com, click the Contact Us button, write us a note, and if you'd like to join us live, check the box, and Mark will do everything else because Mark is by far the best executive producer in the world. Let's get the program started. We are going to an email. This is from Judah, who writes, I would really love to be able to retire early, or at least to have that option when the time comes. I'm 31, I'm married, and I've got a 3-year-old kid, and hopefully a couple of more in the future. I'm looking to target being able to retire at age 50. I should be able to live comfortably on $150,000 a year after taxes. How much should I be aiming to have in my investment portfolio in 19 years in order to pull this off? Okay, here are some numbers. We make about $400,000 a year. We have about $412,000 in pre-tax 401ks, $229,000 in Roth 401k or Roth IRAs, $111,000 in a taxable brokerage account, $110,000 in a money market account. We are currently invested 100% in stocks. Okay. Listen, I can't even tell you how crazy it is to try to do this calculation because we know that you're going to need, multiple millions of dollars, 9 million, 12 million, whatever it is. But what I really want to point out to you is there are a few things that would help us in this process. Number one is, do we need to think about taking some of the money that you've saved, say, in that taxable brokerage account and allocate it for education? How much money are you putting away right now? And why is it that we get to this 50-year number without having some sort of thought about what happens after that? Like, are we going to work part-time? So, Judah, what I'd love for you to do is get in touch with us. I mean, you're going to need to keep putting a lot of money away. It seems like you've already put a ton of money away, but I just need to know a few more facts. And also, is that $150,000 a year what you are actually living on today? Get back in touch with us, Judah. We'd love to have you on the air with us. This next question is from Christopher, who wants to know if I take money from a non-tax fund, whether it's a thrift savings, a 401k, or a required minimum distribution, and I put it into a Roth while I'm still working. I know that I have to pay taxes on this money, but will it count as income for my end of year taxes? Yes, because remember, the money that you are pulling from these accounts has not yet been taxed as income, and it was income. So yes, this is income. Cheryl writes, I love your show. You and Mark make a great team. Both of you recommend what I consider to be a high percentage of bond investing to ride out the waves of the stock market. Every time I look into the long-term performance of bond funds, they're so low, and I don't get it. I have some retirement money in cash, but the vast majority is in broad market or exchange-traded funds. I'm 54, and I will have a healthy pension when I retire, 75 to 80% of my highest 3 earning years. I consider that my stability, so I'd like to maximize returns in my Roth IRA, most especially since I'm off to a late start and I don't have an employer match. Right now, I have only $250,000 in retirement. Am I crazy? Help me understand. Oh, you're not crazy. I mean, as long as you can take the ups and downs of being an equity or stock investor, you're not crazy. The reason why people put up with, endure, or like the relative not so great performance of bond funds relative to stock funds is they do want that stability. So as you get older, sometimes a loss in your equity portion of your portfolio gets pretty hard to take. So the good news for you is that you've got a healthy pension and maybe you're going to get Social Security. And so maybe, you push the pedal to the metal on your Roth IRA and you maximize the possibility of earning more money by being in stock funds. That's fine. But I just want to be clear that as you get older, sometimes those peaks, they're a little less exciting, and the valleys, boy, they hurt a lot more. But Cheryl, feel free to go all in on stocks. Just buckle up for the ride. This next note is from Ryan, who writes, recently you talked to a guest who was worried about funding long-term care in retirement since Alzheimer's and dementia runs in his family. What is your take on him potentially taking a portion of his pre-tax retirement account and allocating it to a long-term care instead of Social Security? Since medical expenses that are more than 7.5% of your adjusted gross income are tax deductible, this could be an efficient way to use a portion of the pre-tax money. And since your guest has a great pension and Social Security, I thought this could be a viable alternative. Of course, this approach could cause higher required minimum distributions later in life, so at the end of the day, perhaps it's a judgment call. Ryan, you actually raise an amazing point, and that is that so many of our personal finance decisions, they are actually judgment calls. And this kind of gets into Cheryl's question as well. And sometimes the question is, which choice will cause you the least amount of anxiety? So for some people, it might be that I'd rather have a tax bill later and know that I can pay for my long-term care expenses today. For others, it might be that I don't know if I'm going to need long-term care, but I do know I'm going to have a tax bill. So in many cases, when we're talking about your decisions to make, we are talking about things that are less bad, less anxiety provoking, rather than what optimizes your life. I really do think that sometimes perfection is the enemy of the good, especially when it comes to your personal financial choices. Okay, this next question is from Jennifer, who writes, my mother is 76 years old and her sister passed away a year ago. She left my mother a house. My father passed away in Maine. So my mother decided to move into the smaller house and to sell her primary. She will use the money from the sale to supplement her income for the rest of her years. She does receive Social Security as well as a pension. The home will net her about $300,000. At 76 years old, would you look at investing that money or maybe just putting it into an interest-bearing account and withdraw as needed? Well, Jennifer, this actually is a question about what your mother's needs are. Does Social Security and pension currently cover her expenses? If the answer is yes, then certainly the money can be put aside as an investment. If the answer is no, that there's some sort of gap, whatever she needs per year should be put into an interest-bearing account. But presuming the Social Security and the pension do cover her expenses, and both of them have cost of living adjustments on them, mom could live a long time. So I would suggest that maybe investing this money in a balanced portfolio, again, keeping the money that she knows she's going to need over the next couple of years in an interest-bearing account. But the amount that you invest could be considered a way for her to fund future things that the Social Security and pension will not cover. If you'd like to ask us a question, just go to JillOnMoney.com, click the Contact Us button, and we'll get your note. The Jill on Money Show will be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and we are here trying to help you make better financial decisions. Or maybe we're just here to give you a second or third opinion about something going on in your life that impacts your finances. If that's you, just go to our website, JillOnMoney.com, click the Contact Us button, and we would be happy to answer that email, or maybe we'll bring you on the air live. That's what we are doing with Julie and Mike. They are joining us from Kentucky. Hello, you two. How are you?
Hi, Jill.
All right, who's starting off? I'm going to start with Julie. Hi, Julie. Did he make you do this? Do you really not want to do it, or are you the instigator here?
No, he made me do this.
Don't worry. We're really fun. Does he make you listen to the show or not? She sounds like she's like the hostage
I
video.
know, she sounds like she's being held hostage.
Yeah, exactly. Julie, how old are you?
51.
You look fabulous.
Oh.
I can't see you at all. And how would you describe your financial situation, Julie, before we let Mike take over?
It is very well taken care of by Mike.
Oh, so you do nothing except you ride on the buggy with him?
Correct.
Okay, very good. And do you guys both work full time?
Yes.
Okay, Julie, how much money do you earn?
I don't know.
Oh, stop it! Come on. I don't believe you at all. I really don't.
All right, Mike should steer this.
All right, Mike, how much money does Julie make?
She's right at 120 a year.
How come she doesn't know how much money she makes?
That's a good question.
Have you abdicated,
she's
Julie?
being shy. That's
Julie,
all.
are you either being shy or completely abdicating responsibility? Either one is okay. I just want to know what we're dealing with here.
I'm completely advocating my responsibility.
Okay, good. Then we'll get back to you. I'm going to tell you why you have to pay attention anyway. But okay, Mike, how old are you?
I am 58.
And how much?
Next month.
Okay, so I'm going to say 59. All right, 59. And Mike, how much do you earn?
I earn 158 a year.
Uh-huh.
That is with the current job, not including the pension.
Okay. What do you mean? Like you receive a pension also?
I do. I'm retired military, 24 years.
Wow. And how much is the pension?
John, I just looked at the take home. The take home, part of it is a disability. The total take home is $7,200 a month. That's after taxes.
Wow. And do you guys have kids?
We do. So we have 3 children. We have twins that are 15, and then we have one that is 12. So we kind of got a late start.
Are the twins identical or fraternal?
Fraternal, 1 boy, 1 girl.
Okay. I am married to an identical twin, and the identical twins say that the fraternal twins are just siblings born at the same time. They're not real twins. I don't want to throw shade on that, but that's just the way it is. Okay. So what brings you on the air with us? I've asked you all these questions. Like, is this like, hey, Mike is saying to himself, like, am I on the right track? Or is there a decision point that's being contemplated? What brings you to us?
Well, I believe that we're on the right track. I just wanted to ensure that certain things are taken care of. And obviously one of those things is if something were to happen to me, that my wife is taken care of.
Julie, this is why you have to pay attention, because he's trying to be a good guy, good partner, and make sure you understand all of this. Mike, what happens to your pension if you were to pass away?
As it sits right now, she wouldn't get any of the pension.
So it goes away. So
That's correct.
No survivor benefit.
Correct.
Okay, just so we know. How long do you plan on working? You're 59, Julie's 51. What are you guys thinking about for retirement?
Currently, the plan is for me to work to 60 and a half. So May 1st of 2026, Julie would be 53, and then we would try to go part-time, both of us, for a couple of years, really to hold off on drawing from the TSP if I could. And then I wouldn't be that far away from drawing the Social Security at that point.
What are we doing about these kids? Are we educating them or not?
We are. So presently, through the military, I have 3 years to pass down, so I can give each of them 1 year. But that also includes their housing and such. If they stayed in state, that would
Right.
go to pay.
So this is the GI Bill, right? So this is 1 year covered for each of them. And then, simple math, I feel like we have 3 more years to deal with. Have you saved any money for the subsequent 3 years?
We have. Right now, they're only each sitting at 20,000.
Okay. 529s,
Correct.
20,000 each. Okay. So I presume, being in the military, you mentioned a thrift savings plan. How much is in that thrift savings plan?
In my plan, there's 807,000.
Okay.
Julie's is 270,000.
Is Julie also military? Julie, are you also military?
No.
Okay. How is it that you have a thrift savings plan? You work for the government?
I work, yes.
Okay, great. That's awesome. So you each have a chunk of money in thrift savings. What else have you done besides the 529s and the thrift savings plan for savings?
So currently I have a Roth that's 92,000.
Okay.
And I have a taxable investment mutual fund is what it is. It's an overseas fund that's 60,000. Actually, now it's 70,000. I'll take that back. Savings of 20,000.
Okay. That's great. And what about your home? Do you own it?
Well, the plan is to pay it off the end of the end of December of this year.
Well, I guess I can't convince you against that. What is the current value of that home?
700,000.
And the mortgage that's outstanding must be a very small amount, right?
It is currently at 42,000.
What's the interest rate?
3.35.
All right. Well, you don't really have to pay it off, but okay. Any rental property?
We do, and that's the other current deal. We have a condo that we currently lease. It owed on it is 92,000 currently.
What's the condo worth?
It is currently worth approximately 175,000.
What's the rental income that it generates?
It doesn't generate any.
Why? Who's living there?
Family friend is what it is. So what we're doing that for, the reason why we got the condo initially, Jill, was to take what equity we would get out of it when we did sell it to, if we needed to pay the rest of education, to do that.
Okay, so do you think the kids are heading to state school or private school?
Initially, they will probably go to state school.
Okay.
And then
I'm just adding up the numbers because, they're, the 15-year-old, the twins are so close. So I'm just sort of thinking, like, are you sort of leaving that condo sale for the 12-year-old more? Because how long do you have before you could potentially sell the condo?
the 5 years.
Okay. There's no opportunity for any of that family friend will pay rent?
Well, they are. We're just, because our kids go to a different school, we are holding that right now, and that'll allow us to stay where we are. And so we essentially, all we're doing is paying the HOA and an electric bill. That takes us over beyond what they're paying by about $600 a month.
All right, so it's not too bad. You made it sound like you're not making any money at all, so I got nervous. We'll get back to Julie and Mike in just a minute. If you would like to come on the air with your spouse or maybe a parent or an adult child, we'd love to have you. Just go to JillOnMoney.com, click the Contact Us button, and we'll get that note. If you want to join us live, check that box. Mark does everything else. It's Jill on Money, and we'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, trying to help you navigate your financial journey. Let's get back to Julie and Mike from Kentucky. So, how much money are you guys spending right now? I mean, I know are you going to pay for the mortgage? Where are you going to pay that? Are you going to use some cash? Or are you using the brokerage account? Like you said, you're going to pay it off. Can't we just let it be? It'll get paid off eventually, no?
It will. I think my thought was to take that extra money, and that would be part of the income that we would have at 60 and a half that we wouldn't be paying a mortgage on.
Yeah, but it's cheap money, and I'd rather you build up your savings right now, or maybe even think about looking at putting some money in the brokerage account. I mean, you have a lot of money that's coming in, right? We know that you make a lot of money together, and you've got that pension. Are you banking that pension right now? Like, what's happening to all this money? I want to understand. Like, do you have a current retirement account, both of you?
That's the one that's at 807,000.
Oh.
I'm sorry, that is the TSP.
Okay, got it. That's the TSP. And are you guys both contributing to the TSP right now? Maxing it out?
We're maxing them out.
Okay.
So
Okay.
are there more pensions coming?
Yes.
Oh, wait. Tell me more.
So one reason I'm staying to 60 and a half is because that will put me at 10 years with the Veterans Affairs, so federal job.
Yeah.
Once I do that, it allows me a couple things. One, it allows me to do a survivor benefit at 50%, which takes 10% of your retirement. My retirement would be, at that point in time, $1,200 a month.
Okay.
Then that would give me the survivor benefit, but it will also let me start drawing that pension right then.
Okay.
And then Julie also will have a pension that will be approximately $800 a month, and all these are COLA'd.
And will these preclude you from claiming Social Security or not?
Will not.
Will not. Okay. And do you have a sense of how much money you spend right now?
So right now we're sitting, this is including with the mortgage and everything, we're sitting at $8,000, actually $9,000, but jotted, including in those expenses, are the savings I'm putting away which I'm putting away $3,000 a month, and that was to go to pay off the house.
I'm forgetting of that. I can't stand this house thing. But okay. So really, the real expenses are $6,000 a month, is what you're telling me.
That's correct. And once, it was going to go down to $400 or $4,500 a month, at the time of retirement at 60 and a half.
Why can't you spend? Why you don't want to have some more fun? No more fun for you?
We do. But
Can't we let's use 6,000. Let's just keep 6,000. That's
Okay.
what I think we should do. Okay. Anything else that we should know about asset-wise, plans-wise, anything like that?
Yes. So the plan right now, although I didn't want to do that once we retire, we will probably continue to throw in. Right now, we're only throwing in $300 per child per month for education. We would probably continue that beyond the 60 and a half age for me, in order to reserve the condo until we needed it, if we do. And obviously right now I've only allocated $300 a month for travel and lodging, which I think we're going to want to increase that for travel purposes.
I think so.
We want to travel.
Yes. So when we're looking at your real expenses, I guess that maybe I'm never going to convince you about the mortgage. I'm going to give up on this, but you don't really need to pay off the mortgage. If you want to, go ahead, go crazy. It's fine. But once that mortgage is gone, and once you have the expenses come down, but you're going to add back expenses for travel. So should we make your real expenses at retirement $7,000 a month? Is that the better number to use? I'm just trying to figure out where we stand here.
I think it is, and I think part of my concern is that $7,000 I think is plenty for Julie and myself. Obviously, us getting a late start, we're still going to have some child expenses until they're off to college.
So what I think is interesting is, obviously, if we knew that the pension, the $7,200 a month, if that had a survivor benefit, I'd feel like you are made in the shade, right? But we know that that's an issue. Do you have life insurance that you're carrying on yourself, Mike?
I do currently. It's $400,000, and that's till age 72.
That's a term policy?
It is.
Okay. I mean, a lot of people, I would say, don't keep that in place. I would if I were you. I definitely would. Because that $7,200 a month is like a real risk if something happened to you in the near term, right? If something happened to you in the next 10 or 12 years and you lost that pension and Julie didn't have that pension, we'd want that $400,000 of term life insurance for sure, okay? Right. So if that were to happen, is there some sort of like break the glass scenario where you'd sell the Kentucky home, the $700,000 house, or is that a non-negotiable that has to stay in place?
Well, we'd sell the condo first, but
yeah, of course. I know. I'm pretending the condo's gone no matter what.
Right. The house would be negotiable.
Mark, how are you feeling about this? Let's just go through some of this. So right now, there's tons of money coming in. There's the $120 that Julie makes. There's $158 that Mike makes. There's also $7,200 a month net that comes in after taxes, after everything.
As long as he's still with us.
As long as Mike stays healthy. That's the number one thing, Julie, the big takeaway here is keep Mike healthy. Future pensions, that will come in will help out. Obviously another couple $1,000s. The expenses are low. There's going to be Social Security. So all this looks pretty good to me. What do you think, Mark? What's your sunlight on this?
As I just said, as long as Mike is still with us, everything is gravy. But that's a big chunk of money that goes out the window, God forbid.
We'll get back to Julie and Mike in just a moment. If you've got a question, something going on, you want some guidance or maybe a little coaching, give us a holler. Just go to JillOnMoney.com, our website, bookmark that website, click the Contact Us button, and let us know if you'd like to join us on the air live. While you're there, don't forget to sign up for the free weekly newsletter. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money, and we are here trying to help you make better financial decisions, or maybe just help you weigh the choices that are in front of you. Now, that may have something to do with your retirement. It might be a real estate question. Maybe it's a question about how to prioritize competing goals like college funding versus your own retirement. And maybe you're just kind of seeking guidance about a job choice. Maybe there's a big job and a smaller job. What's better for you? We'll help you untangle these mysteries. Just go to JillOnMoney.com. Click the Contact Us button, write us a note, and check the box if you'd like to come on the air live. Another way to join us live is to be part of Jill on Money Live, which is our subscription service where for $35 you have access to quarterly live webinars and some special cool video content and the back catalog. We just had a great event doing year-end financial planning and tax loss harvesting, so you'll be able to watch that also. Jill on Money Live. You got to be a member, $35. Let's get back to Julie and Mike. I think what we do is I would prefer, even though, I love that you're putting money in your thrift savings plans, those work. And are you also contributing to Roths on an ongoing basis or not?
Right now, no, based on our income. I haven't done any back door, but once I semi-retire, the plan at 60 and a half, we definitely fall under that amount, and I'm trying to start a business, so we would have a business that we can still contribute to a Roth. Mm-hmm. So I would continue to do that even in our retirement.
Okay. I mean, the reason why I don't want you to pay off the mortgage right now, I know that you really want to. There's like this thing in your brain that's hurting you right now. I get it. But I want there to be as much cash as possible, because Mike, if something were to happen to you within the next 10 years, life is okay for Julie. It's not like a breeze, okay? It's really not. And so what we want to make sure is that you beef up her ability to navigate if anything like catastrophic would occur. Like, this is a very remote possibility. You sound like a healthy guy. All that being said, that is the gaping hole that I see in the plan. Otherwise, the plan looks great. You know, you work, you're happy, you retired 60 and a half, you work part-time, you're putting money away, all that is good. But I think the risk is within this next group of years, if something bad were to happen to you, we'd really want to make sure that Julie was set so that, you know, yes, she might be in a situation where she has to sell the condos. You're going to have to do that anyway, but that there would be less pressure to sell your primary residence, that the life insurance would be there for you. And so in the $3,000 a month that he is putting away for the mortgage, can we put that somewhere? Would you do that? And I would just put in the brokerage account. But if you can't help yourself and you have to pay this off, then fine. But then as soon as you're done paying it off, that money has to go in the brokerage account. Has to. Okay?
Okay.
And the money that you're getting from the military pension, you know, I presume you guys are like, you're not living on that much money. So what we'd really want you to do is take that pension, have it just flow right into the brokerage account. Easy peasy. That just like should go feeding in there. And yeah, sure, you can put money in the 529, but the risk here is more about having liquidity and access to money for Julie if something bad were to happen. The 529s, we know that first year is covered for the 15-year-olds. So the more money you can build up in the 529/brokerage accounts, the better off you'll be. Do either of you guys have parents who are alive, by the way? I just want to make sure we don't have to take care of any aging parents.
We both do, actually.
Are they okay financially? Do you think you might have to take care of them?
Julie's parents are okay financially. Mine, probably not. Probably will need some care of some sort.
Do you have very wealthy siblings?
No.
Darn it. Didn't I give? I thought I only wanted people with. All right. So we should, again, all of this argues for not just paying off debt, but having access to money. And again, the reason is that you have the emotional satisfaction of paying off a 3.35% mortgage. And what I want you to do is have the emotional satisfaction of having a brokerage account that's a couple $100,000 in case someone needs help.
Okay.
Does that make sense?
That's great advice.
Is there any way you can buy more life insurance in your current position?
I haven't checked, but I will, definitely.
I would like to check that out. It would be expensive, but I think it's a 10-year horizon mark where there's really risk. Do you agree with that?
Yeah, I mean, it's open enrollment time, so if you can do it, do it.
This is the time. This is really the time, just to see, just in case. If we can get it and it's not too expensive, I think that would be a good thing to have. You're on the right track. You really are. You're in good shape. You guys make a lot of money. We just need you to be a little bit more focused on the liquidity issue. What else can we do for you? You got your estate documents done?
We do. We have a living will. We do still need you to do our trust.
Yeah. Well, I don't care so much about the trust, okay? What I care about is that you guys have a will, a power of attorney, and a healthcare proxy. That's the thing I care about the most for you guys. The trust is less of a big deal for me, okay?
Okay.
All right, man. Good luck to you guys, and I am very much looking forward to hearing all about the bourbon that will be flowing so we can celebrate your future retirement. If you need a little guidance, just go to JillOnMoney.com and click that Contact Us button. You're back. It's Jill on Money, the program that attempts to take the mystery out of your financial life. And, we are here 24/7. Doesn't mean we're going to answer you immediately, but if you go to JillOnMoney.com and you do click that Contact Us button, write us a note. We'll get the note, and often we'll read emails. And if you'd like to join us live, check that box. Mark does everything else. While you're on the website, you can check out all of our free content that lives there, like the free weekly newsletter, the blog, videos, resources, all at JillOnMoney.com. Okay, this note is from Rick, who writes, "We watch your input on CBS News consistently, and the pain of inflation is that prices remain at high levels. We understand that prices are going up not at that 9+ annual rate, but they're still going up. And we feel the pain of the products getting smaller, and then we have to run out sooner and buy this higher priced, reduced package product. It just feels like there's a substantial impact on our wallets with no relief in sight." I think we all understand this. There's this sense that although people like me go on network news and report to you that the inflation rate is coming down, it doesn't really mean that prices are easing up. And that is because the economy is actually growing. It's sort of a good news, bad news thing. Because when the economy grows, prices do rise. In fact, I don't really want to root for prices to go down because that would mean that we're probably in a recession, which is often associated with job loss or hours cut. And, when prices go down, nothing really good is happening. So here's what we're all hoping for, that wages are going to be rising faster than the inflation rate. And then that gap will start to narrow. And also, by the way, it is emotional. We'll get used to price levels at higher places as time goes by. I know that's not a great answer. I do understand that there are a lot of people who are suffering and their patience is sort of wearing thin. But a lot of this happened in a condensed period of time. I really do believe it's going to get better. If you want to read more about this, you can go to JillOnMoney.com, click in the blog section, and the post-election economy kind of highlights this. Okay, we've got a whole nother hour to go. It's Jill on Money. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's the Jill on Money Show. We are here trying to answer your financial questions. Let's talk to Umberto. He is on the line from Arizona. Hello, Umberto. How are you?
I am well. Thank you for having me. A big fan of the show. I listen to you every morning when I'm walking my pup.
Oh, excellent. What kind of pup do you have?
It's a rescue. It's a mutt.
Oh, nice. That's so cute. Excellent. Very hard with a dog in your neck of the woods because it gets so hot. What do? You have to wake up really early?
Really early, but in the wintertime, we obviously can get out any time of day.
Yeah, that's great. So what brings you to us, Umberto? What can we do for you?
Well, I've got kind of a first world problem. My wife and I looked at retiring in a couple of years. I'm 59 and she's 60, and we had thought about retiring, both of us at 62, but I had a little health issue come up this year, and we're looking at retiring anytime now.
Okay.
And we live in a beautiful home, and it has everything we like. It's the perfect size, but I want a 3-car garage.
Oh, look at you. I want. That is, I get the first world reference there.
Yeah.
That's funny. How much is your house worth?
It's worth about $875.
Okay. And it has a 2-car garage now?
Yes, it does.
Do you have a mortgage that remains on this property?
$250.
What's the interest rate?
2.25.
Oh, brother. Okay. So I can't just build another garage, can I? You're going to make me buy a house?
I can add on to it. The cost is about $80,000.
Okay.
Or we keep this as a rental.
Mm.
And we go buy another house with current interest rates.
Oof.
which my wife does not like that idea.
I just got heartburn when I thought about that. Hold on a second. Let's maybe there's a possibility because you are partial to that as a game plan, right?
Yes.
What kind of rent would you actually be able to make on this house?
Probably in the neighborhood of $38 to $4,000
A month. Okay.
Mm.
If you were to buy a home with a 3-car garage, what would that cost you?
Looking at $1 million in this neighborhood.
Okay. What about an ability to maybe put some more cash down? What about your savings? Like, what do you have saved right now?
Accessible money. We have $517,000 in checking, brokerage, and savings.
Okay. And what about in retirement accounts? What do you guys have right now?
In retirement, we have 2.5.
Wow. And is it all pre-tax or is it some Roth?
No, the retirement is all pre-tax.
Oh boy.
It's kind of small because our 401 account allows us to buy some Roth, but it's very minimal.
All right. So let's get to some of the other parts of this. So
And you like pensions, so
yes, that's what I was about to ask. Any pension assets?
yeah. So the way it sits right now, my wife would get $2,000 a month,
Okay.
and I would get $3,900 a month. On hers, we're thinking about doing 50%. On my pension, it's 50% joint and survivor annuity
Okay.
because the single life annuity is only $200 more, and we figured she would probably want that money.
Definitely. When you look at your spending, given the house that you have right now, what do you guys spend on a monthly basis?
About $12,000.
That's not a small amount. How much you guys each earn?
We earn. My salary is at 180, and I earn about 40 and 35 to 40 in bonuses, and my wife earns about 125, and she makes about 30 in bonuses.
So that's kind of a nice number. Okay. Will your pensions prevent you from claiming Social Security, or will you be entitled to Social Security?
I have not heard why I would not be.
Okay, good. You would know it if you didn't.
Yeah,
And do you know what those Social Security benefits look like?
I sure do. I have a spreadsheet with.
Yeah, you do. Umberto's my kind of guy. I got a spreadsheet for that.
For me, at age 70, it would be 4528, and for my wife at 67 is 4500.
You plan to wait till 70, even though you have this health issue? Like, is there some reason why? In other words, is that health issue a scare that might curtail your life expectancy, or is that?
No, I'm going through chemotherapy right now for colorectal cancer.
I'm sorry.
I had surgery, but if everything goes well, I expect to live till 95. So
Okay.
But once I got this diagnosis, we both started looking. Says, why do we need to work? Let's start enjoying life a little bit more.
Yeah, sure. And what's your?
If we don't need to work, right?
Yeah. So what? Do you have kids that are grown, or do you not have kids? What's your situation?
Both of our girls are working and self-sufficient. We help our nurse daughter out quite a bit. Not quite a bit. I give her a little stipend a month because nurses don't make much money.
Okay. All right.
So in order to survive, she needs a little bit more fun money.
Oh, yeah. Okay. Well, that's for real. Okay. So we are looking at a time like if you gave your notice and you're done, then is your idea that you would use the money that, like keeping the house, your game plan would be you're going to get the pension money. That $5,900 is obviously not all, what you need, but then where were you thinking of taking the money that you need, that extra $6,000? Were you thinking about taking it from the retirement account just to start getting some of that money out?
That seems like the most logical way, right?
Yeah.
I don't want to use my cash.
Yeah, I wouldn't either. I'm not sure why I'd want to have a rental property. You just laid out a lot of different things to us. Okay. Live your life, have fun, retire. And when you retire, I absolutely would take money out of that pre-tax account. you're right now, your highest bracket looks like you're in the 24% bracket, right?
Yes.
I would start taking some money out between now and Social Security and start paying the tax that's due on that $2.5 million. So, maybe you're going to take 200 grand out, pay the tax, live on the rest, and keep beefing up your brokerage account. I'll tell you what I don't think is a great idea. I wouldn't want to take $1 million out and buy a house and then keep the other as a rental. I just don't think, unless you said to me, oh, I hate my house. All we're talking about is an extra garage. And it seems to me that that's not the best reason to uproot your life, having treatments, doing your everything. Like, why don't you just stay still, figure out how you're going to do with your retirement and how that feels, and see how things go a little bit. Get some of the money out of that pre-tax account, pay the tax that's due on that account. Like, all these things would argue to me that not making a big move, pulling money out of the account, getting used to retirement, getting through treatment, all of this, I think, is like what I would see as like a more uncomplicated game plan. If you'd like to join us on the air, just go to JillOnMoney.com, click the Contact Us button, and we'll get that note. If you want to join us live, check that box. Mark does everything else. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
Welcome back. It's Jill on Money, answering your financial and life questions. If you've got one, go to JillOnMoney.com and click the Contact Us button. Let's go to an email from Rob. Each year, I max out my 401k contributions through a defined percentage of my bi-weekly paychecks. I'm at a point now where my annual year-end bonus, which I receive in April, is large enough that I could allocate most of it to max out the annual contribution to the 401k. I could see a few positives to this approach, such as it will allow me to have more take-home pay in each paycheck for the rest of the year. But I'm sure there are some pros and cons that I could be missing. I would greatly appreciate your advice as to whether or not you think the approach is a smart idea. Thank you as always and love the show. Rob, I'm with you. Take that money out immediately. I guess the one downside would be if you put all the money into your 401k and then the market plummets 5 days later, it's not going to be a great year. But over the long term, stock markets tend to go up. So I'd rather get all of my money working as quickly as possible. I hope that helps. Here's a note from Anonymous. Anonymous writes, I have recently been laid off as part of a corporate restructuring, and I'm going to be receiving a generous severance package. I will receive a lump sum payment of about $200,000 gross early next year. I will not be able to contribute any of that lump sum into my 401k. I'm over 50, and I generally max out my 401k each year into a Roth 401k. Since this is not permitted with my severance, any suggestions as to what I can do with a portion of that to minimize my tax hit next year? My severance will be taxed at around 23 to 25%. I'm not sure if there's really anything I can do. I do plan on finding another job at some point next year, but I will be using a portion of my severance to live off of until I get that new job. Okay, Anonymous. The thing is, you weren't receiving any sort of tax preference with your 401k Roth contribution. I guess the question is whether this lump sum payment is considered earned income. And if that's the case, perhaps, depending on whether you're married or not, you may be able to make a Roth contribution. But maybe it just doesn't matter. Maybe you should create a brokerage account, keep enough money set aside so that you can pay for your expenses until you get a new job, and invest, and have that account serve as a supplemental retirement account. If you want more information about this, feel free to get back in touch. This note is from Mark, who writes, I listen to your podcast a lot, and I've taken your advice on many subjects. You finally convinced me that paying my mortgage down at 3.125% interest is done. But what about a boat loan? I still owe approximately $55,000 at a 5% interest rate, and there are 14 years remaining. Financially, we're pretty set. Our household income is $240,000. We live in the Midwest. I could pay the loan off now with part of our liquid funds, about $125,000 total. But I've always enjoyed using other people's money when possible. Does it make sense to pay extra on a loan like this, since the return on pretty safe investments is about the same 5%? FYI, I have been doubling my payments each month to shorter the duration and cut down on some of the interest expense. Well, Mark, I think that you might be onto something here. First of all, it's tough to find a 5% interest rate right now because we know that the Federal Reserve is starting to cut those interest rates, and that reduces the amount of interest you have on your liquid assets. I feel like you do, which is 5%. It's not terrible, but it also is not something that you necessarily want to pay. So I would definitely accelerate this. If $125,000 is a lot more than you need as part of your emergency reserve fund, then maybe even pay more than that. Maybe take 10 or 20,000 of that. But yes, I agree. Paying down that loan at 5% probably makes sense. This is from Delilah, who writes, how does my daughter avoid probate? She's my only child. Do I need a trust? I live in Florida. Okay, Delilah, every estate, every will has to go through a probate process. So I presume that your daughter is the executor of your will, and she would then present that will and go through the probate process with your assets. But I think what you're trying to ask is, how can you make sure the money can get to her more quickly? And that's a little bit easier. First of all, anything that has a beneficiary designation, like a retirement account or an insurance policy, that will pass to your daughter via contract. You can also title your accounts that are non-retirement accounts at many financial institutions with a transfer on death designation, meaning that if I were to die, my daughter gets this account, and that account would avoid probate. What would not avoid probate would be your possessions and your house. So those would be assets that must go through the probate process, and it probably does not make a lot of sense to put your daughter's name on the deed because that may put her in an unfriendly tax situation upon inheriting the house or the condo in which you live right now in Florida. This is from Donna, who writes, I have a question about how and when to pay federal and state taxes. If I were to convert in December, can I wait until April of the following year to pay the tax out of my non-retirement savings account? Or do I have to pay quarterly by January 15th? Also, can I roll over at any age, provided I am in the income tax bracket that I'm comfortable with? Well, according to Mark, who wrote a note to me, that if you were to convert in December, you do not need to pay quarterly tax. You would just have to pay the bill when you file your taxes in April. And no, there is no age limit when it comes to doing a Roth conversion. So as long as you understand that that money has to be kept aside outside of retirement to pay the tax due, you should be in great shape. Here's another email from that very big family, the Anonymous family, who writes, I'm a long-time, everyday listener. My husband is 65. I am 64. I am totally burned out and I want to retire in March of next year. My husband makes $160,000 with potential bonus of $20,000. I make $153,000 with a minimum bonus of $20,000. He would continue working for the next 2 to 5 years. Our assets include my husband's IRA, $1.4 million, my IRA, $216,000. My husband has a 401k with a Roth component that's worth $107,000. I have a traditional 401k that's worth $447,000 and $100,000 in a Roth 401k. Our brokerage account is worth $514,000, and we have $182,000 in a high-yield savings account. We have a condo that has a $700,000 value and a mortgage of $290,000 at 2.99%. We have no other debt, our 2 kids are launched, and we spend about $14,000 a month. My Social Security benefit at age 67 is expected to be $3,200. At age 70, it would be $4,100. His is $3,800 at 67 and $4,900 at age 70. Can I leave my very stressful job in March? Anonymous, it looks like you're golden. When I look at these numbers, here's what I see. I see a lot of assets that have been saved. Yes, a bunch in pre-tax money, so that is important. But I think that for the next couple of years while your husband is still working, perhaps he should pull back on his retirement contributions a little bit to help with your cash flow. Otherwise, what you can basically do is use your brokerage account to live on until you guys claim your Social Security. Now, presuming that you guys are both in good health, you wait till age 70. Maybe you take yours at 67 and his at 70. We'll see where things go. But you've got plenty of money. You've done a great job. And there's no reason that you should remain in a stressful job because you've done the work to give you that get out of jail free card. So Anonymous, go ahead, take the plunge, be careful about the next few years, don't go crazy spending money, and maybe give us a holler back because we might think about pulling some of the money out of the pre-tax IRA or 401k assets before you claim Social Security. There will be an opportunity for you to either use that money to live on or potentially to convert it into a Roth asset. So maybe get back in touch with us. Good luck. Let us know how it goes and take a deep breath. You're on to your next phase. There's more of the Jill on Money Show. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. And when you hear us talking on the air and you want to know where's all the backup for this information, you can just go to our website, JillOnMoney.com. And chances are we've covered this in the blog section, maybe in the video section, in resources. It's all there. Just bookmark JillOnMoney.com. I don't think you'll be sorry that you did. Right now, let's get to an email. This is from Chris. Hi, Jill. Thanks for the show. I love your books and I'm a big fan of the podcast. I'm facing a dilemma. A few years back, NVIDIA, speaking of things that have gone up a lot, was just 5 to 6% of my portfolio. It is so great that it's surged so much, and it's now become, wait for it, 50% of the portfolio. All of that increase came from the stock appreciation. So now I know that you advise that individual stocks not be more than 10%. But on the other hand, AI, it's just starting out. It's in its initial stages. People look for a great future. Should I book some profits by selling NVIDIA so that the value is just 10% of the portfolio? Or is it okay that I keep ignoring this 10% rule? Thank you, Chris. Chris, I'd love to know so much more about you. So here's a few things that come to mind. Number one, we're just talking about this kind of year-end idea of like, what do you do if something's big and, becoming a bigger part of your portfolio? If this is 50% of your fund money portfolio, okay, you hear what I'm saying? The fund money part, and you want to let it ride, you can let it ride. I don't care. But if this is 50% of your total invested assets, meaning when you add this up, is this half of your retirement assets, half of like your real core assets and your holdings? If that's the case, I think we really need to think carefully about how to reduce the position. So there are a few ideas. I don't know anything about you. I don't know anything about your life, but perhaps you are charitably inclined. And if that's the case, I might consider opening up a donor advised fund. You can find these through any of the big houses like Vanguard and Fidelity and Schwab. And what you can do is you can gift that NVIDIA stock into the donor advised fund. Okay. So I'm going to make up the numbers. If it was 5,000 and now all of a sudden it's a $50,000 position, you can take 20 grand of NVIDIA and you can pop it into a donor advised fund. You get a write-off for that 20 grand that you've put in. You don't have to give it away immediately. You've got some time. And so that's one thing to consider. But, if this is truly 50% of every single thing that you have invested, I would encourage you to maybe take some of the gain. Doesn't have to be everything, but maybe you say, okay, I'm going to sell out. So at least I start getting that position down. And, the capital gains rates, they're really favorable right now. I don't know where you stand in this, Chris, but I'd love to know more about you as a human being and your financial situation so we can give you some really good advice. But it's a good problem to have. So let's see if we can kind of suss it out a little more. Okay, this is from Glenn, who writes, I just listened to your Why You Need a Brokerage Account show. This was on the Compound and Friends on the YouTube channel. Anyway, it inspired me to reach out for some guidance regarding my current financial situation. I have a healthy account balance and I'm considering purchasing a car that I can easily afford. However, I have a couple of questions. Should I sell all of my long-term losing investments first to take advantage of the tax benefits? Would it be advisable to borrow on margin against my brokerage account for the remaining funds needed? Margin interest is 6.75%. And I'm wondering if the cost of the margin interest would be less impactful than the long-term capital gains tax. Listen, Glenn, I hate margin loans. Only if you're an active trader am I really into it. And, listen, I've had a margin call in my life. It's not a pleasant experience. Mark, you probably don't know about this, but this was at a different time in my life. But I think what I would do is if you have a healthy account balance, you could sell your long-term losers and then sell enough winners to be delta neutral, tax neutral. So then you hopefully have enough money to buy the car. Again, this has so much to do, Glenn, with what else is going on in your life. I'd love to hear more from you, but I just don't think if you've got a bunch of money in an account, that margin interest rate, why am I paying anybody for the cost of money? You have assets and you can afford it. And the capital gains are not going away. In fact, the capital gains rate may go up. I don't necessarily think that this makes a lot of sense, although I'd have to know a lot more about you and also, what else is going on in your life. This is from Emmett, who writes, Hi, Jill. Do you have any advice for new financial advisors? Boy, do I ever. I don't come from a business finance background, but I switched careers and joined a career development program at a large insurance company. I've learned a lot so far about market suitability, finding clients, but I'm wondering if you have any tips you can share from your experience. Any advice is much appreciated. Well, listen, Emmett, here's what I have to tell you. Learning from the insurance industry angle is not exactly the whole picture. So what I want you to understand is that the lens through which you see the world working for an insurance company is quite different than learning something through the lens of an independent registered investment advisory firm or even a big wirehouse. And it doesn't mean it's bad, because a lot of people I know from the insurance industry have learned a ton and left it, by the way, and become independent and become quite successful. So I think a few things to remember about financial advisory businesses. One is that they're sales businesses. It's hard. You have to bring assets into that organization in order to make money. 2, be very careful not to lead with product sales. And 3, no matter what, whether the insurance company wants you to do this or not, if you really want to understand about being a financial advisor, you should get certified. You should be a certified financial planner. And I think then you would learn a lot more about the whole aspect of planning and what that entails. You can find out more about the Certified Financial Planner designation at cfp.net. If you want to run your financial situation by us, just go to jillonmoney.com and click the Contact Us button.
401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's the Jill on Money Show, and we are here chatting with you about whatever's going on in your real life. And whatever that is that's going on usually has some impact on your money. So if you've got a financial question, we'd love to help you out. Just go to JillOnMoney.com, click the Contact Us button, write us that note. And if you'd like to join us live, just check the box and Mark will do everything else. While you're on the website, there's so much great content there. You want to check out the free weekly newsletter. That's where Mark compiles the stories you may have missed during the week. And boom, you get a weekly newsletter on Fridays. Really good stuff there. You can also subscribe to our service called Jill on Money Live. That is where you have access to quarterly live webinars, special video content, all for the bargain price of $35. You'll also get the whole back catalog. It's kind of cool. So I love those webinars. It's really a chance for us to talk to you in the moment, live, and all of you are there. So it's been a lot of fun to get to know many of you behind the veil, if you will. Okay, right now, let's go to another email. This one is from John. I understand and agree with the principle of rebalancing, but I'm having trouble pulling the trigger on selling 5% of my low-cost, broad-based stock mutual funds. Could you help answer some questions so that I act with discipline? Am I better off selling or shifting regular IRA stock funds into the mainly government bond funds in an IRA account, or sell stock funds and buy the same bond fund in my brokerage account? Does it matter? My biggest problem is I don't want to get lower returns than recently obtained by stock funds. I guess the only answer there is to have the courage to follow the system. Look, whatever your system is your system. I don't care if you don't want to sell something for a gain and you just want to keep everything, do all the rebalancing in your retirement account. That's fine. That's fine. But remember, all those gains, if you, unless you plan on dying and leaving this to your kids, someone's going to pay the gains, right? So I think it's important for you to at least consider that, whatever you're doing, have a system, stick to your system, don't second guess your system. This is why people actually need to work with advisors, because sometimes you're going to trump your own best interests. Okay. This is from Brian, who writes, "Hello, Jill and Mark. I'm 36, single, and I've been fortunate in my career to this point. I have now reached the point where I have accrued significant net worth. Given that I'm single, I haven't felt the urgency to actually set up my estate. But it's changing as I enter middle age." Oh my God, 36 is not middle age, but okay. "Do you have advice for someone in my position? Which documents are critical to have and why? Thanks, and I love the show." Okay, here's what you need to know. You got a bunch of money, right? If you have that money in a brokerage account, as long as that account is called a transfer on death account, you can say, if I were to die, this account goes to blank, whoever that is. Now, it could be a sibling. It could be nieces and nephews, whatever. You can pick that. If you want to leave stuff to anyone, you still have to have a will. And that will is a legal document that it basically is going to transfer your assets to whomever you want to transfer them to in accordance with your wishes. So I think having a will is really important. I think you can cut down on the idea of a trust if you don't want to deal with that right now. I don't know how much money you have, but presumably if you want to just have some transfer on death accounts and make someone else beneficiary of your accounts for like a retirement account, fine. But two other documents that you need: a power of attorney. If something happened to you, like you're like, oh my God, I got into a car accident, I broke my back, but you wanted to give someone the right to go and get money out of the bank because you wanted someone to buy some treats for the nursing staff. Or you said, oh, I want somebody to actually respond to an IRS inquiry. I want to give someone the power to do that. That's a power of attorney. So that's another document you need. And you also need a healthcare proxy, because if something bad were to happen, you need to direct somebody to act as your agent when it comes to healthcare decisions. So those are the three: a will, a power of attorney, and a healthcare proxy. Okay, this is from Carl, who says, "Hi, Jill. I am 63 years old, and I've been married for 36 years, 3 kids off the payroll, and my wife and I are both working. I'm a lifetime saver. I was disciplined at maxing out the pre-tax portion of my 401k, and this year I hit a new milestone in maxing out both the pre-tax $30,500 and the after-tax $46,000 for a total of boom, 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 $76,500. Wow, that's a good chunk of money that you're saving. My employer plan through Fidelity allows for the auto conversion of the after-tax amount, so that after-tax $46,000 into a Roth. Kind of cool. I have my current employer cash pension, which continues to grow with 11% annual company contributions. Oh my God. I'm going to keep that until I retire from the company. But at what point do I start collecting on my other two pensions? The oldest is $272 a month, or a $35,000 lump sum. The second is a plan my current company closed out after a recent merger that has $172 a month and a $23,000 lump sum. Both have a 100% survivor option. I've been holding off on redeeming either of these to reduce tax liability. They're only growing at 2 to 3%. Have I messed up by not collecting them earlier? I mean, it's not the worst thing in the world. I don't see why you wouldn't just pull the trigger. If you like having a monthly check, it's fine. The lump sum, would they just write a check, or would they let you roll over a lump sum into something else? Start, ring the bell, get your $272 a month, get your $172 a month, and call it a day. Just do it. There's no reason to wait for it at this point. If you've got a question and maybe you're a little bit shy, you can always send us an email. Just go to JillOnMoney.com and click the Contact Us button, and we'll get your note. We'll be right back. You're back. It's the Jill on Money Show, and we are here trying to help you make better or less bad financial decisions. And you notice that when we talk to you, we do have a sense of humor. We like to laugh a little bit, but we are not judging where you are. You are where you are. We want to help you get wherever you want to go. And it does not mean we have to interrogate every past decision you made or judge you. Just want to help you get to the next best place, or at least understand what your options are. So always go to our website, JillOnMoney.com, click that Contact Us button, and check the box if you want to come on the air live. While you're on the website, you can check out our other shows. We've got 2 podcasts. We've got a blog. We've got a video section. We've got resources, links to my books, everything right on the JillOnMoney.com website. Very easy to navigate, I promise. Let's end with an email. This is from Corey, who writes, I watched your episode on the S&P 500 versus the total market, but I also wanted to know your thoughts on the S&P 500 versus the total world market. Would this still be too much overlap, and would it be adding more fees than just staying with the S&P only? Okay, what Corey is talking about is our YouTube show, which is called Jill on Money, powered by The Compound. In these 5 to 7 minute videos, we're trying to tackle some of the most frequently asked questions. And this is a biggie. So what Corey's really focusing on is how to add international exposure through an index fund. So what I would say, Corey, is if you want to buy an international index fund, buy that. You can buy that, and you can buy the S&P 500. But I don't think I would just layer on more of the U.S. market if you already have exposure through the S&P 500. I hope that helps, and if you have follow-up questions, just let us know. Okay, that's it. That is the program. Boy, it goes by so quickly. I can't believe it. Our music is composed by Joel Goodman. Mark Talercio is our executive producer and king of all things web. And in fact, all of our stuff lives on our website, JillOnMoney.com. Try to do something nice for someone else today. Change your work, change your wealth, change your life. Thank you for listening. We'll talk to you next week.